All right, everybody, welcome to the
Yes.
November 2024 jobs report and inflation update. My name is Albert of Albert's List, and I will be your host today along with Colin and our presenter, Dr. Reilly White, the Associate Dean of Teaching and Learning and Associate Professor of Finance with tenure at the University of New Mexico. If this is your second or more time back, we'd like to welcome you. If this is your first time, our audience has certainly grown, and we'd like to welcome you into the fold for what has become a monthly tradition on Albert's List as we discuss the state of the economy, the trends, news, and views impacting your job search, and what you can do about it, whether it's to actually continue job searching or just have really, really great conversation over eggnog this holiday season. Uh, so the way this goes, we hand it over to Dr. White here in a moment, but you can answer questions throughout. Use the webinar chat to provide your commentary and insights. We keep things neutral here. We keep things fun. We keep them frisky. So, we keep it there, and we'll have this also on YouTube in just a couple of days. So without further ado, Dr. White, welcome back. We're really looking forward to what you have to share. I'm going to make you co-host so that you can actually share and we
Powerful.
can see what you've been discovering over the past month.
Thank you, Albert, as always, for being here. It's an honor to speak to Albert's List and all of you out there on the job market today. Colin, as co-host, an excellent source of questions I also get from Colin around this. I will try to answer all the things. And if you've got a question, put it in this chat here. And even if I don't get to it, even having Aaron here means that Aaron probably will. So it's really great to that you're here tonight. Thank you for being one of our participants, either here at home streaming or live. It's so great to talk about the economy. My name is Reilly White, as the indicated, and today we're going to venture on a magical adventure. And let's go in the slideshow. I'm adjusting my display settings. We're making this thing happen. AI generated, not very good for diversity AI generation. I said, put a bunch of tech executives over a map of the Bay Area. And they're like, okay, let's add San Francisco in the background, I said. And they say, how many Transamerica pyramids do you want? And I'm like, I don't know, 5? And they just keep adding them. Here's one there, here's one there, here's one there. It's a rainbow of magical things. The decoy Transamerica pyramids. Really, it's very special. Albert, I don't know. It just comes up. All of my everything I generated in AI always has an Albert watermark. So it's just a coincidence, I think. So it's really, really awesome to be here and really good to talk to you guys. So let us rock and roll. Why isn't your face in the clouds? So let's talk about November a bit. I'm going to jump right into charts and make it look like you're attending a very important presentation. So if you've got friends, relatives, spouses, other people who have no interest in economics, bring them in. Now, don't bring them in. It looks like you're very smart and very important. Put these things up everywhere and people won't bother you. So let's talk about the November 2024 jobs report. Following the news, you're like, this is a great jobs report. And it was like, last month was terrible, but this month is great. It's back to normal. No, no, no. That's not how any of this works, right? We know that we're looking at a monthly record back and forth. Monthly is noisy. Last month, we were suffering from the slings and arrows of outrageous hurricanes and a labor strike that was significant. And that ended up knocking our job numbers down to 12,000, which were since revised upward about 24K. Since that time, we added 227,000 jobs. But instead of looking at this as like a 0K job month last month and 227K today, notice that there's things here that are, I would look at this as a 2-month 100K average, which is not really not really stellar. You're not reaching for the moon here. You're not really doing things that really say I'm an outstanding job market. And I'm not really keeping up with, say, population growth or immigration and all those things. So as a consequence, we do see this uptake a little bit in unemployment rate. And if you're asking me, where are we finding these legendary jobs that we haven't found in the information sector? It's not in information, it's in healthcare. Yet again, solidly, the same number as last month, 72,000 jobs added in healthcare. Leisure and hospitality, solid number 2, 53,000 jobs. If you're a service sector worker or in healthcare, opening your own line of ambitious health insurance and other timely parties, you're doing really well. But everything else is tough. Demographics, America's getting older, money's going out this way, we're increasing this, a lot of venture capital floating around in this space. As a consequence, it makes sense. Melanie says, Albert says, instead of learning code, it's learn to clean a bedpan. That's great. Sorry. Let me take this outside. I used to be in computer science and I've got 4 degrees. Let me do this instead. It's really a rough market out there in some sectors, but healthcare is still flying off the shelves. 17% of our GDP goes to healthcare. Great. Wow. Melanie says, does driving for DoorDash count as leisure and hospitality? That's actually a very good question. So you're looking at this, I would say yes, because is it restaurant sector based? But I'm actually curious about how the Bureau of Labor Statistics counts this. So I can divide a sector this way rationally and intellectually as we talk about this. And if we look at something like DoorDash, we can look at it solves, it depends on what problem it has. It is a provider fundamentally of food delivery services. Some would argue that it is a information industry and also in the communications services sector. So that's actually a really good question of where we would actually see those numbers, Melanie. Because let me get into there and let's dig deep maybe into the Bureau of Labor Statistics data to figure out how they classified those things. I think it might be in a terribly undiscoverable, it might be almost undiscoverable because I can get finite, but I'll try to find the subcategory that best calls it. Usually we think of leisure and hospitality, they'll be looking at service sector workers, restaurants, and hotels and the like, and that kind of thing. Jill says, seriously, end of life care. Everyone wants to be a death doula now. Absolutely, absolutely. Man, that's not, and indeed, what a service to provide. To your point, Jill, and exactly right. We're looking at a situation right now where if we look at end of life care in particular, one of the things that we talk about in finance quite a bit is how much people underestimate the need for end of life care as they approach 80, 85. And I think the ratio is once you hit 65, you'll have a 50% or greater chance of needing long-term care, aka leading to the point of near-death care and other cares that you need to require. So this is actually a fascinating business to get into and possibly, and almost ominously, and possibly morbidly, a growth business. Colin says the great wealth transfer from boomers to geriatric care and hospices. No, Colin, that is so witty and so good because Colin's right, because everything's like, oh, it's going to be a generational wealth transfer between boomers and their children and grandchildren. And meanwhile, no, they're going to be spending the money to the point on hospitals, medical care, hospices, long-term care. That is where a lot of that wealth is going to go. They're going to sell houses and that's where it's going to go. So Colin, again, with the slam dunk on that. Albert says, Eve, during the darkest days of the Great Recession in 2007 to 2008, healthcare was adding jobs at tens of thousands per month. Teflon industry, it is, truly is. And demographics in their favor. Ooh, EHR coding, Aaron, dropping the mic like it's hot in there. Oracle, Epic, all that stuff, solid to do. Cleaning bedpans, says Brett. Absolutely, good to see you, Brett, again, too. Welcome back. So it's good to have the old team together now. So let's go back here for a second and talk a little bit more about this jobs report. So interestingly, there was one losing sector because they actually do something. They actually adjust the jobs report based on where they think previous averages are, previous economic information was. It's an adjusted number. And right now, even though retail sales are up, hiring adjusted is down about 28,000. And so we lost jobs in retail, meaning that a lot of places, well, adding the money and adding the things are doing more with fewer people, fewer hours in different locations and different places, which is what we're seeing right now. Labor force participation hovering at 62.7 for a while, down to 62.5. Are people leaving the job market because they're frustrated by it, or are they leaving because of other reasons? They're so successful or so happy they don't need a job to live, or are they retiring, or are they doing other things, or are they going to grad school? Who knows? Not going to grad school. This is a good question. So Albert, absolutely right. Retail should be up, and the expectation is it's up, but these are adjusted numbers when I reflect this. So when we look at the Bureau of Labor Statistics values, they're seasonally adjusted, and it didn't hit that seasonal level, and so it shows it down 28K, but it isn't as catastrophic as it seems. It is meaning that labor, despite higher retail sales, retail hiring has not been seasonal like it has been in past years, which is really interesting. Could be e-commerce as a perspective in this. I have this, I have a lot of family members who work in some capacity in different retail environments, and their essence is there's fewer people on staff now. Sales are still really good, but there's fewer people around, and the hours are being shifted, and the people there are doing more. And it's interesting. So Brett says, my daughter got a job as a medical scribe at a brand new children's hospital. Congratulations. Finishing up has her bio degree. Did that job even exist 2 decades ago? I'm always impressed at medical scribes because of the technicality or the technical nature of the information they have to know. I'm very bad at notes. I'm very bad at copying technical notes, as anybody in any class that I've attended can attest to. Very fascinating stuff. Retailers seem to be closing more stores now, says Albert. So no more holiday hiring. Convert malls to affordable housing instead. I agree with you. And the hard part is, of course, if you can manage that and manage those development costs, which we'll get into in the real estate section, that's going to be a really tricky thing to do. That's cool. Healthcare front, yes, exactly right. And so upward revisions. So good news in this job report. We had upward revisions in September, up 32K. October 24K. What are upward revisions? Well, the Bureau of Labor Statistics releases unemployment and employment data, which is based on surveys. And when these surveys come in, they have a sense of how the economy is doing, and then they adjust it mathematically for other data that comes across. They'll look at hiring data, they'll look at other technical sector data that they come in, other things that help them produce a refined picture of the hiring market. And that resulted in, over the last year, ending September 30th, about 1 million downgrades, 800,000 downgrades over the previous year, 800,000 fewer jobs. But right now, we've seen at least upward revisions in September and October, which means there's 56,000 more jobs than we thought there were previously. So boom goes the dynamite. Let's rock and roll, see how far this thing goes. Nominal wage growth, and I want to mention this as well. Still, wage growth is growing at 4% per year. That is still ahead of inflation, which means every month, wage growth is better than inflation. Most people, or the median person, tracks ahead or gets a little bit richer, then stays ahead of these price increases that we've seen. Now, this is not uniform, and it takes a long time for this to filter the effect in the economy. So although people are still feeling the effects of price increases, as long as wage growth remains above inflation growth, that means that people's salaries are going up faster than the cost of goods, which makes people happy in the long run. But it takes a while for that to kick in. So unemployment in the chart at the top right, ticking upwards, as you note. We're going to get into this. It's not always a steady ride upward. It is up and down, but the tendency is higher unemployment over time. And also, fewer jobs being created. This is a weakening economy. Make no mistake. We are seeing a weakening economy today. So one of the things that we saw in the last month in particular, and there's kind of a chart of all those different sectors I was talking about, with retail down there at the bottom. Information, flat. Neither a person hired nor a person fired. No, it just netted out, of course. Utilities, the same. Information has been down, and indeed, we're going to talk about the Bay Area. Information down 6% from a year ago in the Bay Area in terms of the amount of people that are employed in that sector. So it is affecting a lot of things. And while you're seeing a recession, I'm going to also build a case for you to think, well, hold on a second. We're seeing a recession in the tech space, in the information space. It is not a recession across the economy, and it does not mean there are doldrums that are permanent for the Bay Area in terms of VCs, as I will show you next with some additional data coming up too. So this is going to be we got all kinds of shenanigans to talk about today. Thank you for sticking in on this miraculous adventure. 45 people, amazing. Thank you guys for being here, and I appreciate you. So employment change by industry on the left. Now let's talk about earnings. Nominal wage growth. Although there's pressure on it to decline as prices go down, we're looking at employers looking to maximize profits, lower this wage growth. We're not seeing it yet. So it's not such a weak job market that employers can get away with not raising wages for people. And that's good news so far that we're still doing this. Is 45 people more than your economics class at UNM? So we have capacities. We try to keep our Anderson, which is the school of which I am responsible, which is our Anderson School of Management. We're the second best Anderson School of Management in the country. But one of the things, to your point, is we have 60 people max in class. So we could make it 100. We could make it 200. But no, that's no fun for the students. And you know how it goes. Aaron says, given how diverse the U.S. economy is by region, sector, investment, banking, central banking, we are not close to recession. Absolutely true. We are away from a recession. We're far from it. Doesn't mean we can't do it ourselves, and it doesn't mean a recession won't come in a year or 5 years or 10 years, but it's just not here, and it's not happening now. So Albert says, are we still in the realm of the SAM rule? So the SAM rule, Claudia Sam came out with this rule. She's an economist. She has a very cool Twitter, and you can follow her on those things. I don't know what else she's on. X. Sorry, got to get with the times. Sorry, Reilly, it's 2024. Now, No, 1996. But one of the things is, are we still in the realm of the Somme rule? Meaning that, do we notice that in general, unemployment rates are 0.5% higher than where they were before? We're looking at a weakening job market. And yes, in short, but as Claudia Somme herself notes, it is not a perfect measure, and there's a lot of other noise that goes along with this. It means we are definitely in an economy that is weakening. And while it is for many states, within some rule calculations. The unemployment rate has come up enough where we're at a level where we are in a position of seeing some of this negative economic energy. We had such an exceptional period of low unemployment rate that right now we are still very, very close, tangibly close to full employment. Not to worry about yet, nothing to worry about yet, but it is still weakening. And until we turn this corner, then it's going to take a while for me to be jazzed. Colin says wage growth is often bad for stocks, but good for people. Interesting. Overall, is nominal wage growth good for the economy? Yes. People get paid more money, they spend more money, and that's good for a slew of all the companies out there. So if a company's out there to make money, whatever type of company it is, having additional wages helps that. But then you ask the question, Reilly, where do these wages come from? And then we can argue it depends because there's a few ways. There's government transfers. We have 3 million federal employees. That's about the same as what we had over the last 4 decades. But if we pay them more money and the government uses tax money to pay for that, it's like a transfer from the tax system into the economy in some way because people will spend it and buy stocks and do things with it. But Colin, to your point too, wage growth is challenging because, we see it if wage growth stays at a high level, and it's hard to say what level that is, if it's 4.5%, let's say, 5%, let's say, and inflation, that does put upward pressure on inflation. Give people more money, people can charge higher prices. And so companies respond that way. And that also often is one of the reasons that we're often perhaps a little psyched about the risk of higher prices. But so far, we're kind of threading the needle in this space. Colin, what do you think?
I'm just like, I think the question is trying to edge towards the discussion on federal minimum wage and whether or not we should raise it, because obviously the last time it was raised was like 2007, and
Yes.
it doesn't feel like we're raising it anytime soon. And always the question is, if you raise the federal minimum wage, then you introduce inflation. I understand that, but like
Oh,
how,
yeah. No.
I mean, like if that's like the hard rule for the next 2 decades, will be
Yeah.
like, is the federal minimum wage still going to be 7.25 an hour
No.
in 100 years? Like, when do we
No.
raise it? When is the best time to raise it?
That's
Is the
a
question.
that's a really weak empirical argument, but I hear it all the time. To your point, Colin, people are like, I can't raise minimum wage because that'll go for inflation. So here's the thing: if we look at the physical percent of people, and I looked at a study recently on this because I'm like, well, we'll see about this. You get in those nerd fights with other nerds as we do, and we kind of like slap each other, and it's one of those things. And I was in this thing, and we're talking about this aggressively because this is what we do in this career pathway. But one of these things, passive aggressively, passive aggressively. We're very passive aggressive people. But we get in there and we're talking about this, and the amount of people that are physically at the minimum wage is actually a relatively small amount by a percentage. We're talking about single digit percentages anywhere in the country, like 2%, maybe 3%, earning literally the minimum possible wage that you can, which means that raising the wage earning capacity affects a relatively small number of people and is such a small addition to the overall economic picture because these are the lowest paid Americans that it won't shift inflation itself. You're not suddenly going to see somebody at McDonald's saying, hey, I bought 3 yachts last weekend. I'm so glad I'm earning 850 now. That's great. It doesn't work that way. And so because of this perspective, people are get really worried about that. Oh, to raise inflation. No, no, no. There is effects of raising minimum wage that have been studied. And we've looked at this. I made my students I looked at over 100 papers about this. And we classified them, we looked at them, we tried to figure out what it was. The job effects are where it's at, but it's minimal. What happens is firms because they have to charge higher wages. If you're a fast food industry, you shift it away and stop hiring teenagers, hire more people who are experienced. And then they do another thing, which is more nefarious. They reduce the number of hours that people actually work. You're like, okay, so you earn 7.25 an hour. You worked 25 hours last week. Now the minimum wage is $9, so I'm going to give you 18 hours a week. And they're going to make these little mathematical calculations at the margins to try to bring down people's money. Overall, though, it's to your point, Colin, not an excuse for inflation side, and of course for a bunch of reasons, because it's such a drop in the bucket for the overall economic picture. It won't move that thing. We can get into little like nuanced fights about the job effects of this and other things and how it incentivizes firms to act certain ways. But I wouldn't be worried about inflation from that.
Got
Great
it.
question.
Well, then,
Great question.
I mean, like it just sounds like the summary and takeaway for decision makers and stakeholders is raising wages is good for the economy. Like, is that the wrong takeaway?
I think it's good. So raising wages to an extent. So if I doubled everybody's wage, we'd probably have inflation, right? But
Yeah.
raising wages is good, especially if it keeps ahead of inflation, because that makes people wealthier as a whole. And so this is interesting, right? Money's going up, money's going in, and we have this 4% wage growth, 2.5% inflation. So it's like 3% inflation. That's pretty. We're making money off of this. That's how we create wealth and magic, is if we can keep that number higher than the inflation rate. And it's an interesting question. It really is.
Mm.
Very few, to Albert's point, very few jobs in America are at the minimum wage, but they do affect real people's lives that are at their level. Tom says, should we also consider the change in worker productivity? Tom adds an additional variable, which he's absolutely right to produce here. In this section, productivity, we're going to get in productivity too. One thing that's been shining, relatively speaking, in the last few years for the United States, productivity growth has increased. Wages are an incentivization for higher productivity growth. Now, some of this increase in productivity growth we've seen in the United States, this has not been replicated in Western Europe. Some of that explanation is through more hours and more pay. And there's a lot of issues, there's a lot of debate over the extent of what those factors actually are. And that'll be a factor of studies in future days. Aaron says federal minimum wage is less than 2% of the workforce. See, that's what I'm telling you. We should index it, collate to inflation, also do $1 true up every 4 years to drive this long term. Yeah, that's fair. So I think that's fair. So Aaron's got the right perspective on this. Increase minimum wage, tie it with inflation, cost of living additions. That's the way to be. You can do it. You want to increase inflation that way. I wouldn't worry about that. And especially if you plan it out that way. And to Aaron's point, because it's not a surprise, then the job market adapts to that. And that's something that it's not a surprise. It's not like, oh man, I've got to now prepare for this. And I'm going to give all my employees 80% fewer hours because wages are 10% higher. And it's going to be a really interesting, it's an interesting give and take, but it's something that creates more net good in the short run, depending on levels. But again, it does have effects, and we can talk about those. It does have effects. I'm sorry, I keep going back and forth here. Marcia says, raise minimum wage or introduce universal basic income, UBI, another exciting thing as well. So that's also a factor of, there's been some very interesting studies on UBI. I should actually talk about that later because that's really interesting. Universal basic income, a fundamental question that we could add is, and certainly something we could spend money on to ensure that there's a minimum standard. There's a lot of things, though, that we have to figure out, too. One of them is housing prices. One of them is insurance prices and healthcare costs and other things. And so I think our debate over the next 2 decades as a country is going to be how we value these things and how politically we handle these very, very challenging topics. Because it's really interesting. Marcia, that's a great point. And I should talk about, maybe I'll do a dive into UBI next time. I love it. Or make sure you ask a question, too, because Marcia always... Oh, Marcia always, but she always asks really good questions into the generic chat windows that Albert gives me as he gives me like this dot matrix printout of questions. So in the United States, initial jobless claims. So kind of alarming this month, although we had good news overall. This week, we're up to 242,000 jobless claims. That's higher than about the 200K level we've been seeing. And for a while, I grew optimistic because from August to November, we've been kind of seeing this slightly declining trend of initial jobless claims. So these are people who are without a job for the first time. And so for one reason or another, they were laid off. And as a consequence, they claimed unemployment insurance or something like that. And so right now we are at a level that is not catastrophic, but it is higher this week. We'll keep an eye on this to see if this goes up in time. Now, Albert also points out the U6, up to 7.8% now. And the U6 is a measure of unemployment, which includes discouraged workers. So workers who are not only looking for a job or either have a job or looking for a job, which is what we see in our unemployment rate. We call that U3. There are 6 big unemployment measures. There's U2, which just measures, Bono's unemployment rate. And there's U3, which is the most commonly quoted one, which looks at the number of people who are working and the number of people who are looking for a job. And then U6, which is the broadest form of unemployment, that looks at things like people who are looking for a job, people who are discouraged, people who are underutilized in the labor force. And to Albert's point, it's now at 7.8%, and it was 6.7% just a year ago. And we're up 1% there, and that's nothing to sneeze at. We are, again, getting slightly worse, but in a good news is in a slow fashion, which is maybe something we can adapt to. So, speaking of satisfaction, are you happy with your job, Albert's List purse people? Are you content? Do you enjoy it? Do you wake up every day and say, what a new adventure I'm on? And if you said no, you'd be with the slight majority of Americans, and a majority of Americans that has been ticking up fairly gradually over the last 5 years, who are either watching for or actively seeking a new job. Extremely satisfied people. I am so satisfied with my job. Down to only about 18% of the population. So before, if we think of those ancient days and pre-COVID times when 27% of people were extremely satisfied, people are less satisfied with their jobs as a whole. Interesting, isn't it? Now, one thing that has been brought up about this, or a question that I had a couple cycles ago in the Albert's List universe, was talking about offshoring in general and looking at the risk of certain jobs to offshore. Different jobs have different offshore risk that has been assessed. And if we go from 0 to 100, where 100 is the highest amount of offshoring risk, meaning that this job needs to be taken to another country that's in the United States. If I'm any type of CEO, I'm shipping it. I'm just shipping it abroad versus, say, companies in the low area where there's a minimal amount of offshoring risk. We actually don't find, from the scales that have been measured across different metrics and different things, that there's a big correlation so far, at least in the 2007 to 2017 period, in the risk of that job going overseas and it actually happening. Because we look at the, say, job growth in this period, and there isn't a clear ramification. We see some jobs, certainly, that have high offshoring risk have done really poorly. Some have continued to grow in the United States. And so it's very interesting to see how this will be, this will change, especially in the next 5 or 10 years. Colin says, did Elon Musk get counted 4 times because he's 4-time CEO? Yes. He just fills out all the surveys. That's right.
He also has time to be the top player in Diablo 4. I can tell you that's a full-time job by itself.
That's absolutely right. Oh man.
But just to make sure I'm understanding what we just learned,
sorry.
There's no correlation between offshore risk and job losses. So when someone says they're moving the jobs to China or Vietnam, that's not true. Or is
it is happening for sure. But the thing is, we just don't find it's correlated the same way in the marketplace. So we thought that initially, and this is, if you notice, the thing about drawing any line between any point, even one that looks like a very passive smile, like you're looking at something that mildly amuses you, that you might be slightly interested in. You're like, yeah, it's definitely a closed lip smile. So we'd expect this to be a much more downwardly sloping graph, right? Because we'd expect job growth on that left-hand side to be highly negative when offshoring risk was also really, really high. So we'd expect kind of a downslope line all the way across here. And we don't see it, but that doesn't mean it isn't happening. We just note that it's often very peculiar to individual industries that are these little green dots here that have different perspectives. Some high offshoring risk industries don't go offshore. Some do, is probably a better reasoning for this. And this is really interesting. And this is also true too. And because this data set is to this point old, Angela brings out and says, hey, but don't you think that the offshore risk likely spiked post-COVID? I think so too. I think I'd be interested to see in the continuation of this data set. But this came out in another little shindig online, so I'm going to find out if we have any more recent data on this as well. Because you're absolutely right, COVID and remote work increases it, but there isn't always something. So the moral of this story, what I'm trying to get at here, though, fundamentally is even though you say this particular industry is very prone to being offshored, doesn't mean for one reason or another it will happen. There are frictions at place that can prevent that. So for instance, if I'm operating a bank, I might say, Oh, if I have credit analysts working for me. So people who are deciding whether a bank loan is worthy for an individual commercial customer, or evaluating that commercial customer for a bank loan. Yes, I can absolutely offshore those mofos. I can take everybody abroad, rock and roll, you're free. Congratulations. Get back to me, when you can. I'm just saving all kinds of labor costs. There is an added benefit, though, when you can talk to the person, when you're close to the person, when you're near them. And so banks have done a couple of things. Some of the larger banks have offshored these jobs. Some have not. Some have kept them here because they view it as key for relationship building. And both have their niches. And so the idea being that offshoring risk is kind of a monotonic or kind of a highly generalized statement that's valid across all industries, I think is false. And I think we can say that it's highly specific to different industries and their priorities. So, boom, I think it's interesting. Colin, what else? What do you think?
I wanted to ask, does that friction work in reverse? Say
Mm, yeah.
the I believe the incoming administration is on record saying they want to bring back jobs from overseas. What is the
Yeah.
exact mechanism for that? Does it work in reverse? Is it hard to push out and hard to bring back in? Like,
Good
how is
question.
that possible?
So hypothetically speaking, Colin, so the aspect of the opposite of this, onshoring, moving stuff back here, could encourage could happen. It can reduce supply chain risks. I mean, it improves, some people could say it improves sustainability, supporting local economies, customer service, all that jazz. We can look at logistics costs, other things. But I think when we think about this generally, there are a few things that we can do. One is that the CHIPS Act, for instance, had an effect of reinvigorating American silicon wafer manufacturers, right, among other manufacturers. And so, because of this international component, we started building more factories, putting more money into this, and building this infrastructure out again. For some sectors, this will work. For highly advanced technical stuff, which we never developed to the extent that Taiwan developed, South Korea developed, or even Germany developed, for like real, when we think about industrial production in a very technical specification way, that's not been the United States' specialty. Other countries have lapped us in that many times over. Because of global supply chains, that was fine. You can bring those jobs back, but it's going to be really hard, right? When it comes down to looking at other things that we often offshore, for instance, it's hard to make the case for repetitive task work, right? There isn't a lot of people who have the desire to sit in a factory for 10 or 12 hours a day. And not to say that there's a question of ethics in that altogether, but looking at that and saying, well, this isn't, 1900 and we're operating in a mill town in Manchester, New Hampshire, trying our best to kind of make enough money to just take home each day, or working in a coal mine and then owning all that money back to the company's store. It's fascinating to see, but it's not possible for all jobs. And this is the real friction to your point, Colin. We cannot bring back jobs that have left us and we lack no personal expertise. And then there's jobs that we could bring back, but then we have to develop a whole expertise to fill them. Like we do not have the technical infrastructure to meet the highly technical industrial specification needs of places like Taiwan or Germany. But we'll see. Albert says Klarna CEO is on record gloating that the company doesn't hire more anymore because of AI. Maybe, maybe that will affect us. Maybe we'll see how that'll affect us. But I think it's also going to result in productivity increases, which will mean we'll hire in other places. Colin said replace their C levels with an AI. Chris says Trump and SoftBank CEO announced the company will invest 100 billion in US projects. Absolutely right. Oh, SoftBank. It's fun to see SoftBank coming and doing it. Well, $100 billion, I think there will be a lot of US projects, but they won't be universal across all industries, but they'll be good. I mean, in some ways it'll bring it back, but there is the question of global supply chains. They exist because, it's a real shakeup of our traditional global supply chain infrastructure. Melanie says, my contacts in Arizona say that the new fabs in town won't hire locally. They're bringing in people from Taiwan. That's true. We can't get the people. Let's bring them in from other places. Let's go to Taiwan. Let's bring them in, rock and roll, and incentivize them. How could you make, how could, what could make onshoring more authentic? That's right. Let's literally take your entire factory in Taiwan. Let's move it here and call it, America Town, and it's going to be great. Great for us. Real amazing. Aaron says trying to bring back 15-year Java programming. Vertical experts with legacy systems make zero sense. Zero capitalized. Bum, bum, bum. You think, Colin? So Another Albert's List favorite is, should I quit my job now? Should I stay? Should I go? Should I go somewhere else? What should I do? Oh crap. Sorry about this. I just like, fixed my mouse wheel and now it's hyperactive. I'm not used to its immense mouse wheel moving strength. So Albert says American Factory featuring the Ford Factory, a great documentary. Oh man, on Netflix. Absolutely right. So going back here, if we take one of the things the Atlanta Fed wage growth tracker allows us to do is I can go in there and we can go in there and we can take the wage growth for job switchers over 3 months and subtract the job stayer wage growth. And normally this is positive in most positive economic times. So for instance, if your wage growth, for instance, generally speaking, is going to be 1%, maybe even 2.5% higher, like it was in COVID, to switch jobs rather than stay. A few times in the economy, for instance, right after the tech bubble, and again, kind of on the trailing end of that Great Recession, especially in 2009, 2010, right in the middle of the Great Recession, it was actually more sensible for you to stay in your job than switch. Also, briefly, during the little snafu we had in 18, but since that time, we just actually, incidentally, earlier this year, it was better to stay at your job than switch. And now it makes about a 0.5% difference to actually switch your jobs rather than to stay. So very interesting stuff. Aaron says the new TSMC factory in Arizona is the highest productive semi-factory in history, semiconductor factory in history, already 5 to 8% better than any other factory in Taiwan, and it's less than 2 years old. That's good news. So I went in March, I went to a silicon wafer manufacturer in Japan, who I'll leave anonymous for this purpose. They also maintain a factory in Arizona. And I brought a bunch of students from New Mexico, and they're all like, you have to build in New Mexico. And they made a case for it. And they're like, no, 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 that makes no sense. It's really hard sometimes to get practical investment in this case, but there's a lot of American locations, towns, cities, and places that want to see that onshoring, that manufacturing come back to them because it fills that niche that we haven't had in some time. And it's going to be interesting to see if we can do this successfully over the long run beyond the CHIPS Act. So, Colin, what do you think?
So there's an interesting question here, and being a person who recently job switched because of
Ooh.
the benefits significantly outweighed staying, why don't companies prioritize retaining existing talent uh,
Mm.
over the possible, like compared to the risk of losing talent? I'm sure like people have probably done cost benefit analysis, but in my mind, it's like it's never a good it's almost like if you want to lose a problematic worker, I totally understand that. But like if you also have like a worker who knows your industry inside out, who's been around for like 10 years, and they're like, "Hey, can I get a 15% raise?" And you're like, "Well, I mean," versus them just going, "Well, another place is offering a 25% raise if I jump." And then like the knowledge loss and maybe stakeholder relationships that person's built up over the years. That's hard to quantify what the exact loss will be, but I'm sure it's a significant loss, especially with the knowledge loss. I personally think, and this was like in my experience when I left my previous company, is like the knowledge loss was insane for them. And I spent the last 2 weeks, during my notice period, basically documenting as much of my knowledge as possible, knowing that it would still be probably less than 40% of what they're actually losing.
Colin, can we pick up that pamphlet? Colin Moe's Knowledge and other things. It's an 800-page novel written in the turn. I'd like to pick that up. That'd be good. What do I know about my job? It's only 40% of what you need to know is what I got here. That's the title. That's the hook. So to your point, Colin, this is a very good question, and it's one that has been many people have asked this over time. There is a grounded cynicism and an even expectation that people will embark upon multiple careers in their pathways. And I think everybody who's been a boss before, and myself included, knows what it's like when you've got your star employee, you want to give them the world. And it's not your fault sometimes. It's just like life comes in the way, they do other things, they have other dreams, other goals. They move out anyway, no matter what you do to retain them. There's no amount of money, no amount of things you can shift their way to get them to stay in some way in your company or firm. And it's very hard. And that breeds a certain cynicism to the question of that type of investment, Colin. So this is a very good question. 40 years ago, par for the course in banking, for instance, to have analyst training programs. Let's teach you how to be good analysts. Most banks don't even waste their time now. Learn it on the job, see if you can make it or not, and then you leave. And that's difficult because that lack of investment means, to your point, you're not giving people a rudimentary knowledge in something. You're not actually training them towards a goal, and you're not even getting them aligned to a certain company objective and the way that they see themselves and they see their business. But also, to your point, maybe one of the reasons that we see in response to this are industry clusters everywhere, right? The Bay Area is one big tech industry cluster. But if you look at other places where you have industry clusters, a collection of businesses that are about the same that work together, it is because I know that I can poach you, Colin, and I'm going to get your knowledge. And then that guy's going to poach me for your knowledge. And collectively, the industry knowledge will end up being shared anyway. And maybe that results in a competitive industry ultimately, instead of a lockdown. So maybe there's a silver lining in this, in the fact that you switch and you move your knowledge, and they're poaching people, and companies are all poaching people because you all live in the same area. And as a consequence, this builds the aggregate. That's why so many companies are located in the Bay Area, because they know that they have a shot at getting you to work for them and bringing your knowledge with them. That's it. That's the secret sauce. Colin.
Why doesn't this work for the military?
Oh, you mean like
We give the military a bigger budget every year, which I
that's
guess
a
is like retention budget. They have nowhere to
right.
actually jump to. There's no competing that nation buying our navy or whatever, right? So why do we need to give them more money every year? If I looked at this as
Yeah,
an HR case, I'd be like, hey, you have nowhere to go. You either work for us or you go pound sand. So I'm just gonna lower your budget. Like why doesn't this work with the military?
that's right. It is very difficult to induce a competitive economy into stuff like the military, to your point, where I can say, oh, this is a poaching thing. I think you'll see. So this is actually interesting. So to that point, I was just discussing this with one of my co-authors the other day, Yorgos Marinakis, and he worked for a bunch of national labs. He worked for Lanel most recently, and did a whole bunch of other stuff in other places. So interesting you say that, because we wouldn't see it necessarily in, like, if you're talking about like, necessarily like, people on the ground or privates operating. Think about the tech transfer that exists between the military industrial complex and the private sector, right? This give and take. So if you're working for a national lab, you've got some incentive in some way to patent that, maybe even get out, maybe start up, partner with a private company and do that. And this is sensible because the military doesn't know how to do everything, but it can kind of bring some of that information out there, use private expertise, and then bring it back to the military later after it's cooked for a while. And so this is a really interesting dynamic that they have, right? And it works really well from an innovation side. And we're working on something for political economy that's kind of around this exact topic. And I won't go into like too much details on this, but it is a back forth transfer that isn't the same as the one you describe. We see it in tech because that's what we research is tech, but we see it. But to your point, the question of how to induce those incentives in public sector economies is an unanswered one, really, and effectively.
Well, the question just boils down to like, then why do we raise like military wages specifically? Like,
Why does it go up?
yeah, why does
Yeah,
it go up?
why don't we just keep them at,
They have
sorry,
no
it's,
competition. They have no really real option. And if we just like lower their wage every year, what are they gonna do?
well, isn't that like also saying that they're a monopoly? Can't we just say that, oh
They
man,
are a monopoly.
we
The
have we
military
have one
has
military. They
the
can
military.
wage set all they want, Colin. It's amazing.
Yeah.
I think that is actually part of our cost problem, besides the Baumol's cost disease that is affecting every aspect of our economy. We don't have a we don't have a cull on that military budget in a reasonable way to use that effectively. And that's a oh man, that's a great question. That's a great point. I love it.
Yeah, I'm just like, there's no one competing with the US government for the US military. So why doesn't the government just say, here's the military? We're gonna lower this, we're gonna cut this.
Yeah. Here
And
it
they're like,
is.
hey, every four-star general, you're now going to make significantly less because we say so.
That's
And
right. And then
so
they're going to
you can
leave for
go
the private
elsewhere.
sector. And
Yeah.
then we're going to have like, this is hard. If we don't play market wages for people who are like in generals, you get what you pay for. And so if you want, like, this is a good question. We're going to end up with a series of like, not to say we'll end up, not to say not, maybe we'll end up with a more incompetent series of buffoons managing, nuclear warheads, because we only pay them $2 an hour. Why would you pick a career in it though? That's my question. I like your cost cutting. I like President Colin's cost cutting.
It's all about cost cutting. Hey, we're trying to be efficient.
That's
You
gonna be
know, if Elon Musk, you want it, just hire me into Doge and I'll be like,
yeah.
hey, this is unnecessary. This is unnecessary.
So if you had a forced draft where people had to join you and then you wanted to pay them nothing, absolutely. I think that would work. I think that would work. Here's your $1 a day. Then you're effectively, it's like prison labor camp. They'll call them.
It's all a matter of how you introduce it and frame it, right? For example, Facebook makes billions off of all our content and we do
Yes.
that for free.
Mo military, mo problems. The Colin Mo story. I love it. This will be fun. I like it. It's not a bad idea. It's interesting. But I see how it could go haywire though. There could be, we do have a lot of nuclear secrets.
I'm just like, every year we increase the military budget way more than most people get an increase in their
That's true.
wage, right?
How do we control it though? This is really true. I taught project finance for people at the labs and they just laughed me out of this place. They're like, I'm sorry. We don't need, this is very cute, Reilly, that you're interested in cost cutting and measuring dynamics of cost cutting. And they said, no, no, no. If we don't make our budget next year, we get a smaller allocation next year. So even if we are efficient about spending our money, we have to spend it arbitrarily at the end of the fiscal year on things like 10,000 desk chairs. It doesn't make a lot of sense.
I hate the OpEx problem of if you don't use it, you lose it next year.
I
That's
hate
such
it. I hate it too. It doesn't
I
make
don't know
sense.
who introduced
I
that
love
and
this.
who's continuing that.
Who is this? I know.
Yeah, who's continuing such a terrible
The
tradition?
entirety of our current government military infrastructure, from what I'm gathering, from what my people tell me, my people.
How come
I'm
that
telling
doesn't
them
work for insurance? Insurance should be like, hey, you didn't use insurance last year. We're gonna reduce your premiums. Like
that's
what? That
exactly
never
what it
works
is.
the other way.
Yeah. And I'm like, no, I feel like I would just wait. I'm like on my deathbed. I'm like, I'm not gonna go to the doctor because it's December 31st, and if I wait a day, they'll lower my premium. Melanie says AI CEOs would probably favor retention. That's hilarious. That's probably true. Yeah, AI CEOs. Thank you, AI CEO. A retention of other AIs. I don't. Albert says, also seems that while factories may return, how much of them will be automated? Good question. Oh, and Angela, of course, coming in from HR, says it's really costly to bring everyone up to market wage. Most companies can't afford it. That's why ratings and tying ratings to performance pay is extremely helpful so you can help to pay the best performers. Exactly right. Very good point, Angela, too. Good thing there. Look at that Arizona chip plant yields link Aaron dropped in there. That's excellent. So are we on our own? In my experience, Jill also says most people don't read your documents until after you put together to help them. I went to my company after a short time after my layoff. No one read my notes. That is true. That is true. We try to get notes and we think it's the right thing to do, and then for some reason there's always like a significant knowledge loss, no matter what you do when you leave your job. Charles said, agreed with the point in my notes in the role. In my role, things move so fast that pretty much everything is just handled on a weekly basis. Success is more determined by the ability to run with the flow versus memorizing processes. Run with the flow. That's great. I like it. Run from the SEC. That's what we call it in finance. Angela says, but government wages are so low. That's absolutely true. Aaron says, got enough. Foreign meters cutting edge, getting higher yield than a tier one AAA Taiwan plant. That's solid. And we got military, cost cutting, batting, cyber. Okay. And then Melanie finishes, aren't some enlisted military already eligible for public assistance? That's possibly true. Some of the lower wage folks, in the privates, for instance. Colin, for those in HR that have company exploring inference engines, I highly suggest having exit interviews and knowledge dumps be fed into the inference engine to drastically improve knowledge retention and context for future work. Love it. It's my favorite engine, the inference engine.
Oh, 2025 is going to be the year of inference engines and AI agents.
Bam, you heard it here first, everybody. Inference engine is this year.
Yeah.
Choo
I
choo.
can't
Here I come.
I from my vantage point and where I work, it's where every month every company is throwing money. And inference engine is basically a personalized chat GPT, if you don't know what that means.
Oh, I love it. I love where this is going. I think it's very helpful. I think these will ultimately lead us to greater productivity growth, I think, in general, things like this, and it'll be good to see how this pans out. But I'm still maintaining an optimistic perspective here. Now, on this, one good thing to note, especially out in California, California's economy is poised to overtake Germany after showing steady growth, even though the it has been a rough year for the information economy at all. Right now, it is rougher in Germany. And both of these economies now both about $3.5 trillion. This is also due in part to the strength of the dollar, too, I want to point out. That is in certain ways allowing exaggerating the decline in German GDP by relative to the size of this. And it's been a very interesting question to consider how one advantage that the United States has is sort of the innovation culture we create and how important it is to not destroy that in coming years and to continue to grow that culture of innovation. Yes, do we mind? Yes, Colin, how far away from that? How far away are we from that chip in my brain that I can just, go off into outer space with and, collect my memories?
Ask Elon.
I know, ask Elon. I know, right?
But Elon promises so many things.
He's promising a great deal lately. This is great. So I was asked by, and one of the questions in my Colin Albert list of questions here was looking at kind of our macro summary post-election. What are we looking at? Throw some numbers in it, Reilly. What are my predictions over the next year? What are we going to do? So I think we'll see some continued slow weakening and uncertain road ahead that depends on a couple big variables at play. And it depends. It could be good. It could not be good, but it depends on a couple things. Economic contradictions. So first of all, the U.S. economy grew at about 2.7% in Q3. Unemployment remains low. It's a little bit higher now for two. But election-driven policy shifts. I think we're going to see in the next year pro-business policies, good for business, deregulation in places like energy, banking, and mergers and acquisitions. So that might set off a chain of M&A. It might set off a chain of other things. Depends on financing rates and a lot of other complicated things. However, on the downside of this, increased immigration restrictions and protectionism, both those things slow growth, depending on the level of commitment of the government to both of those things. So immigration as a whole, not only does it lower the average age of the country, but it fills jobs that we can't fill in the United States domestically through just being ourselves. And I think that the economy in the next 100 years, that economies that will prosper will have a way of attracting and keeping immigrants in a way while also being able to build things like housing, sufficient housing in such a way. Real GDP growth still decelerating here, 1.8%, 1.3%, only because of I'm making a bet, and this is the hard part on the impact of tariffs here. And that's a really interesting question because tariffs will be a drag on the economy. To the IMF side of this thing, I mean, with a trade war, it drags the economy down a percent and a half of GDP annually, the longer it lasts. And whether this is bluster, meaning that President-elect Trump is doing this in effort to gain some superior competitive advantage through negotiation, it's a negotiation tactic and it's going to go away, or if it becomes part of our general country policy, it will, whether it is short-term or long-term, will dictate the impact of those things. So labor market dynamics. I think they'll see cautious hiring, potential layoffs, but I don't see increasing unemployment too far beyond 4.5% in the first part of the year. I think strong retail sales. I think prudence on lower income households are coming, and I think we'll see some cooling spending growth. And finally, deregulation and protectionism will probably create inflationary pressures by 2026, depending on how far it is. The economy is like steering a battleship. Nothing's going to happen in January that destroys the economy, but there's issues that'll come down the line March, April, May, June, depending on what's put in place, how much of that is put in place, and how long that stays in place. And that will be a drag. But, that's a really, really tough thing to grapple with and I'll talk about tariffs next because it came up on this. Aaron says Germany economy is crashing into a deep recession, which will bring the EU into a recession. Add France government falling, EU is in real trouble. It is a bummer because they are also a big trading partner, and a rising tide lifts all boats. We should want everybody in the world to be growing their economies because that's markets for everybody else. If you think of no other thing other than that pragmatic fact. that does put downward pressure on our economy just by virtue of the fact that they'll buy less of our stuff if they are doing less well. And Melanie says, I read praise for the Trump administration's protectionism, and of all places, the leftist humanities nerd Bible, the New York Review of Books. That's Melanie, I love your comment so much. It's so great. So this is really interesting. So Melanie, you bring up a good point. So protectionism is praised here, but I'm going to go over why protectionism kind of sucks. Because it's not popular on the protectionism is kind of popular on the left and the right for various reasons. But I'll kind of talk about that in a second. But it's going to be tough. And then what is troubling Germany besides energy costs? Good question. So of course, a lot has been talked about Germany and energy. They said, "Oh, let's get rid of, let's put ourselves in a position of, shutting down nuclear plants, doing other things." Now they ended up being, more dangerously reliant on, say, volatile partners like Russia. They need to generate more energy. That cost pressure is on them to do so. They have an economy that has failed to innovate meaningfully to the extent that we've seen in other places. And I'm going to show you a few unique characteristics. Probably the rise of neo-Nazis. That doesn't help. Nazis in the mix aren't fun, but they're not going to, and it's going to be a challenging road ahead. I was speaking with a German professor from Osnabrück when I was at the conference in Dubai I was at in November. And we were talking about a number of things, and I'm like, so what's the deal? Olaf Schultz and all that, what's happening? What's the deal with the German economy? And so everything's in trouble, from Volkswagen and their plant in Wolfsburg to every other German company are dealing with, just a situation where they cannot innovate, they cannot generate, they cannot generate significant technological or productivity improvements. There needs to be changes, but they don't have a government right now in that capacity that's capable of making those changes. And so them and a lot of parts of Europe are also suffering from this. And it's just really, really unfortunate because the EU is it's still such an area of promise for growth and unity and all of these things. And I think it's in everyone's interest, if we view this very positively, that Germany finds a way to become innovative and a strong partner again, because we're all tied together in very true ways. Integrated supply chains. Yeah. With slow trade, there it is. Look at that. Look at Aaron's little side here. That's creme de la creme right there. Little Aaron action. So tariffs would crash the U.S. economy as both countries represent 4 to 7 trillion in trade. FDI, integrated supply chains. Attempting to enforce tariffs would slow trade by 500% to 1,000%. 1,000% slower at every customs transit point, which would collapse demand, drive up cost prices. Exactly. It sucks. It's going to suck. It's going to be terrible. And here's why. And let's talk a little bit about tariffs here, because this is a deal. Because I know some of you are jazzed about tariffs, and that's fine. You're like, tariffs, that'll protect my job. Maybe, but it won't. And here's why. Let's go back to 2009, because I'm going to show you tariffs are in fact something every president, no matter whatever political stripes that you are in, have dappled with, have played with, have toyed with. And so 2009, this was a President Obama tariff. He put a 35% tariff on tires from China. And what did it do? Saved 1,200 tire jobs. Well, not saved per se, but ensured that these jobs weren't laid off. Yay! 1,200 tire jobs. And that's what he goes around telling people, which is right. But what were the effects of those things? Chinese tire prices, because of that tariff, rose 26%. So they passed on some of those costs. It didn't go up 35%. It went up 26%. But then domestic tire prices rose 3%. Why did domestic tire prices rise? Because of lower competition from Chinese competitors. We charged higher prices for Americans, costing Americans $1.1 billion more than they were paying before. So what does that mean? People bought fewer tires. And who lost jobs? Retail workers. So we saved tire jobs, but we lost 3,700 retail jobs. This is tariffs in a nutshell, right? You're saving X, but sacrificing. So you can save one job here, but then you sacrifice 3 jobs over here. And the hard part is that people don't see the interconnectivity of that. They're like, yay, tire jobs. But then they're like, no, I don't see the other effects in the economy, nor least the rising prices. And so let's think about this. And back a couple years back, the IMF did a little analysis around these shenanigans, and they've decided and took a look at what would the macroeconomic impact be in the United States for imposing tariffs on imported goods. If there was no well, if there is no retaliation, and again, if you impose tariffs of 20%, which is their assumption, which is right here, and get no retaliation, you're living in just a magnificent unicorn-laden fever dream where none of this is actually real, and your expectations of global parties to say you're not gonna hit U.S. imports with tariffs, are you? But we're gonna hit you with them. That's not how the economy works. Every country will embark upon a retaliatory trade war that will end up within a period of 4 to 5 quarters, affect the GDP to the tune of 1% or 2% or more. And this is just a 20% tariff on imports from emerging East Asia, which was a smaller percentage of our economy than, say, the Japan and Mexico is. And so, to Aaron's point, it's going to suck. Also, for this too on tariffs, when we think about tariffs, most trade is in something called intermediate goods. These are unfinished goods. These are not exactly the stuff you find in store shelves. These are the ingredients. These are the widgets that go into your car built in America. These are the computer parts to your computer built in America. Anything built in America has parts from all over the world. These are these parts as they come through. Those prices come across. That takes more money to build the parts we need in the US. That's passed on to consumers. Boom goes the dynamite. You get inflationary pressure. So I really got to reiterate this. If you have one takeaway today from this lesson, please note that tariffs are rough.
But they're terrific.
But they're terrific.
On a different question is we've always asked how does the country implementing tariffs, what does it do for them? But I don't know if anyone's asked the reverse. If we put tariffs on China, how does that affect China?
Good question. So it does affect Chinese exporters, right? So if you're a company in China and you employ 1,000 workers and you make tires, and then suddenly you're hit with this and you're able to sell 1 million tires a year in the United States because you can undercut them because labor costs are lower, or you've got this better system in place. Great. But when you face a tariff, what that does is it makes your product less competitive. So that tire you're selling for $80 now costs $100 or something. Let's say, simple math. Let's do $96. Suddenly, your tire's not competitive. People don't want to buy it anymore. And as a consequence, your sales go down. You have to lay off workers. And that's the other issue too. And so you're furious as a business owner because your international tire market that you're selling, now your tires, which you're making for very cheap, you have to sell for a much more expensive rate because of tariffs. And then as a consequence, fewer people buy them. And you got to look at where your workers are, and you got to either cut your margins, cut your workers, or do something else to compete. And so it's terrible, terrible.
Will it make the domestic tire market in China cheaper?
Good question. So you're saying, so if we impose tariffs on Chinese goods, would that make the domestic market in China cheaper? Interesting question. So let's think about this. So that's a good question. So I don't know. It would depend on the magnitude of those effects. So I don't know a lot necessarily about the regulatory thing. So if I build something in Shenzhou, will I end up being able to ship those tires all the way to Beijing? Or will there be am I limited by some, complex bureaucracy I don't understand? So I'm going to ignore that for a second. But let's say my tire factory right now, I'm a Chinese tire, I don't know, executive. And I'm rocking and rolling in I made this wonderful product that's better than the American tires, or as good as the American tires, but I can sell it cheaper to America. That market's shut off for me now. I might be more aggressive about my domestic market right now. But the point is, what probably made me successful in the American market was I was able to hit all the American requirements for a good tire, right? The tire rating, specifications, type. I'm going to have to retool for whatever the Chinese market needs, and I'll have to make that adjustment, and that's a cost inherent in that adjustment. So that's a business cost on me. Maybe I'll do it if it's the same, but it's going to be tricky, and it's going to be a thing, and the Chinese market may not want my tires. That's a good question. So some firms are very good at competing internationally, but very poor at competing domestically because international rules and regulations, right? The ability to compete in America will depend on a lot of technical expertise that you understand in the American market that you can't necessarily pass on to make cheap tires in the in the Chinese market. Good question. I think, though, to your point, to your Colin, what I think is really going to happen is if it does happen that way, it will force Chinese firms to be much more cost efficient, actually, about certain things. And that may, when tariffs drop or when tariffs are lowered, they might end up making the companies that survive will make tires better, maybe because of the pressure we put them under. That's an optimistic take, but I don't know. What do you think, Colin?
I mean, it does sound like an optimist. Mm, I just see tariffs like they're a tax, right? They're ultimately a tax on the consumer, but they're forced.
Yeah. Oh,
And
good.
then
Yeah.
I guess the goal is to drive consumer behavior to
Right.
consume domestically produced goods instead of imported goods. Uh,
Right.
but everything I've read, and I'm no economist, is just saying, hey, depending on what is going to be tariffed, this could impact things like raw materials, which is not specifically an imported good, but is
Right.
used to create other things. I don't know how good our rubber industry is, but I do know tires are
Right.
made of rubber. And if Goodyear does not have enough rubber to make tires, they're going to have to import rubber. And if the imported rubber is 35% more expensive, they're going to add that to the cost of the
Bam.
resulting
That's right.
tire, right? That's just how I see it.
You're
As a
right.
consumer, I'm not
That's right.
happy.
That's
Give me
right.
a 35% raise, and I'll be happy with the 35% tariff.
Yeah, right. Give it a Colin-based tariff, right? Give
Yeah,
Colin tariffs
give
go
me
to
a raise,
Colin,
and I'll
you
be
pay
okay with the
Colin. That's
tariff.
right. It's
But just
one of
yeah, I don't.
that was the inference of the tariff, I think. That's part of the inference tariff. It goes right
Yeah.
to so Marsha points out a good point too, that I think Chinese firms would set up shop in Vietnam. I think you would see a lot of international characteristics. You'd see a lot of maybe that would force a lot of wouldn't it be fascinating if our protectionism resulted in Chinese offshoring? That'd be fascinating. Um, I don't have an answer for that, but I love it. I can see the mechanism for that how that would happen. Charles said there was a Chinese car company looking to ship into Mexico as a way to get into the United States. Oh yeah, that's true. That's true. That's a case study too, and that's how a lot of cars first made it there too, or even cars that yeah, exactly right. So rocking and rolling. I know I got limited time, and it's already 6:13. So let's rock and roll with this thing. It's overall. So here's some things we got to think about real quick. U.S. fiscal deficit versus other advanced economies. We're really bad about managing our budget, and we continue to be bad about managing our budget. To Colin's point, we're really terrible at this. We're really terrible compared to other companies. And although it's not countries, although it's not an issue for us right now per se, it will be down the line. Because remember, when we spend more money than we take in, that's a deficit. And that's 1 year is a deficit. If we do that year after year after year, in total, that's the national debt. That's money we owe ourselves, everyone else. It's not something that's terrible, but that is something we have to pay off. We can issue a a $20 trillion coin, but what's that going to do? That's going to pay off bonds across all of our markets and ourselves and would likely result in a inflation shock to the US economy. And so we got to figure out a way to get and make our budget straight. And we haven't actually balanced our budget effectively since actually the mid 90s, interestingly. And so this is really interesting. Oh, Marcia says, I just picked up The Deficit Myth. I have that book, Marcia, and I'm looking forward to the rebuttal of this chart. So I know it's a big deal. I know there's a lot of ideas out there, but economics is still economics. For instance, we still have to pay interest on the debt that we take out. So if we take out debt, and although our interest rates have gone up and they've gone down a little bit, but they're still up, I mean, the most nefarious part of this is that for every tax dollar we spend, a couple of years back, we were spending 6% of our money on interest servicing our debt. And now it's more like 8 to 10%. And it's projected to be like 12% in the coming years. That's money that could go to healthcare, military, social sciences, whatever you want to do with life. That's money that we're spending on debt instead of other things. And when interest rate goes up, that becomes a bigger drag of the economy. A few years back, I had a student from Jamaica, and he gave this presentation about the Jamaican economy in the mid 2010s when 60% of their government budget went to servicing debt. Imagine if 60 cents for every dollar of your tax money just spent on servicing debt. It makes you less efficient, it's a drag, and it kind of sucks. So we have to Think about it. I did. Did I recommend it? I didn't recommend it. I don't feel like I would recommend that one. Did I do it? Was I maybe I was having a maybe I was sometimes I enter a space. Melanie says tariff enforcement could overtake healthcare for employment growth. So that's a good idea. So Melanie, I like your optimistic strategy. Maybe you'll have really cool uniforms. You'll have like a big T on them, and you'll be like tariff enforcer. And you just walk around with like a big, like one of those like those sticks from old timey police officers or something. A baton. Like it's decorative. And you just go there and you tap on ships and things and say that'll be 35%. That'll be fun. So, quick note on building stuff. Building anything, even luxury units, tends to lower prices. This is called the filtering effects, and I submit to you the academic article from Bratu et al. From 2023. Good read if you're interested in this. So, when you build luxury apartments, it can make other stuff cheaper. It can make rents cheaper because the people that are taking up middle-class units might be wealthy. And those wealthy people move into those new luxury apartments, freeing up spots for, say, middle-class people to live in normal middle-class homes, and lower-class people to live in places where they can afford. And so it does filter around. So even when you build luxury units as the only thing, it does result in lower prices. And if we look at some data from this year, the annual growth in apartment rents versus the amount of apartment supply that they built, the places that increased their supply the most saw declines in their rents, whereas the places that didn't increase their supply saw increases in their rents. Build, build, build.
Build
Oh
back
man, this is
better.
build back better. Build right there, the Colin Mo complex, a new series of 85-story apartment buildings right there, somewhere in Pacifica. No, they will never let you zone that, but you can try. Jill says, is there any in the world being a software engineer is a good thing? I'll leave that up to. Software engineering is the most magical thing in the world. Is everyone going the way of the USA? That's a good question. That's interesting. Aaron says, yeah, it is a good deal anywhere. Software engineers are good engineers. We mint quite a few ourselves at my university, and I hope that it is. But let's talk about that for a second, because where do we find software engineers? We find them in VC areas. And one of the issues that we've heard a lot of things, and this is again, I want to re-inject hope and dreams into the Bay Area. Right now, what makes the United States special is if you're a startup company, we've got the money for you. Indeed, we've got $129 billion of VC investment in 2024. That is 4 times higher than every other country. And the change, we're up 9% this year. Only India and Canada have seen higher percentage growth rates. And Canada, 1/9 the population. But look, they're chilling with a $5 billion VC investment. And where does most VC happen? Where does it happen? Look at the chart on the right. It's the Bay Area, $50 billion of VC investment. And indeed, we're up 3% over the previous year. That is 3 times higher than New York. That is 5 times higher than Boston. And surprisingly, even Denver's up there, number 6, $7.5 billion. Although I am fascinated by the implication that Denver's VC investment is like twice as high as Paris, which is fascinating.
Denver's trying hard.
I know.
Denver's trying very hard. Colorado's like, hey, we want a Silicon Valley too.
I know they got their own little mountain valley. They're cooking. 207% increase in VC. Look at that. Bam. And then the Research Triangle in North Carolina, 2.7 billion, up 224%.
I'm surprised Seattle is so low.
And even San Diego. Amazing.
Why is Seattle so low?
Yeah, it was eaten up. They've got their companies. They like, this is enough for us. We're done. We're just No, it's really interesting, actually. I'm actually curious why Seattle is so low. I was surprised. Maybe Jeff Bezos just, he's buying everybody out. He's paying you to not enter. He's like, this is Amazon country now.
There's 2 monopolies there.
That's right. But kind of, right? I wonder, to your point, there's a study, Colin. That is a statement that will result in a great paper. if I only had time to write it. That'll be good. Because I guarantee you, I wonder the effect of local champions sometimes if they've undergone accusations or deliberations around being a monopoly. Does that have a chilling effect on VC investment in these cities? Interesting.
Hmm.
Aaron's
I'll take
dropping
that.
it like it's hot. So unicorns, by the way, let's talk about those. Unicorns are startups worth $1 billion or more, right? So we've got a whole bunch of them, United States. Where's that big red dot? I know this is kind of an eye test. Don't scream if you're on your iPhone. Don't. If you're driving or operating heavy machinery, please, please continue to do so. But look right here, San Francisco Bay Area, you're looking at just an incredible concentration of unicorn firms. Again, a sign that this is where the money is if you're in that area. That's why you're here. Other news about home prices, and I want to kind of dig in quickly on this. Inflation-adjusted home prices over the last 134 years. Are houses more expensive than your parents and grandparents paid for? Yes, when they're even adjusted for inflation, among other things. So home prices right now on a ticket upward, about twice as expensive as they were basically between 1895 and 1995, adjusted for inflation. What a great time to be alive, people.
There are no $300,000 homes in Bay Area.
There are not. I could assemble enough cardboard to temporarily construct something illegally, I think, in a local park, but I could not do any more in this.
I don't think I could buy a garage for 300K.
Oh man. That's terrible. It's terrible. I'll show you. That's true. Because I did a little thing in the Bay Area coming up next too. Melanie says I've answered a portion of those 40K job listings. No joy. Oh no. Aaron says houses are 2 to 3 times bigger and built with 3 times more modern features. That's also true too. When you control for, so this is a good question. So Aaron, to your point, this was the critique of this chart was that it doesn't control for the increase in square footage that we've seen. But again, this isn't just looking at new houses, it's also looking at old housing stock as well. And it is exceeding the growth that we've seen even in square footage. So it would, though, to your point, controlling per square foot, diminish the apparent growth rate, but the growth rate would still be higher to your point. Like we're talking about the average house size between like 1890 and 1950 was like 1,100 square feet. It was tiny. It was small. Not a lot of joy. Oh man, this is rough. So inflation, it's happening. It's still happening. But it's leveled off, but it didn't disappear, which is why we got to watch this thing. To Melanie's question in the chat window, she asked previously, would leaving or renegotiating NAFTA be like the US version of Brexit? So in short, it wouldn't be that bad for us leaving or arriving NAFTA. What would be bad? Tariffs would be bad for us. That'd be bad for both economies. NAFTA, the North American Free Trade Agreement, signed in the 90s, an imperfect agreement that has been renegotiated at certain levels at various times. Very imperfect. And, this is a tricky part too. In the 90s, economists in general, free trade is generally always considered better than constricted trade, the alternative, right? So, but the free trade when it's how can I say this? Unmanaged creates disparities. The aggregate wealth increases for an economy engaging in free trade, but it also creates it also exacerbates the difference between the wealthy and the poor, which is something that economists in the 90s, we didn't really understand that effect enough. And as a consequence, what we've seen with increased, higher Gini coefficients, increased issues involving just wealth discrepancies, this is part of that issue that we see. Number of movers and mover rate, also interesting to note, people are moving at a lower rate than any time that we've seen post-war. There are fewer people moving now than we've seen in any economy post-war, meaning moving out of state, for instance, geographic mobility. So if you moved out of state to go to San Francisco, you're rare, or to go somewhere else, you're rare. And it's going downhill, and house prices are part of that issue. Yeah, Angela says, the problem with the job market is everyone is looking, even employed people. You're right. Yeah, Aaron says it's led to an explosion of 10 trillion transformation of Mexico, Canadian, Sunbelt, Northwest, Midwest economies. Absolutely in aggregate, Aaron. I'm just acknowledging the point that it does exacerbate wealth inequalities. I mean, free trade in general does good things. It does better things than bad things, but we gotta look at all the effects. Productivity surge. This is good news too. U.S. productivity is continuing to rise. This is really interesting. And actually, Q3 2024, we're 0.1% above forecast. And we've caught up to kind of our trend line since 2020. This is good news. Two ways to grow an economy, right? We grow aggregate, we grow the population, or we increase productivity. We are able to make more stuff, right? Just with what we have. And our productivity is rising, which bodes well for us. One thing is, number of federal employees. So this lot has been said, it's been thrown around on Twitter. We got to cut federal employees. Now we can pay for federal employees. We've had about the same amount of federal employees as we've had basically since 1970, more or less, about 3 million. Where we have seen an explosion of government workers has been in state and local payrolls. We've seen that explode substantially from about 5 million to basically 20 million. So state and local governments have expanded rapidly. The federal government itself has not. So California housing costs, my favorite slide of all time. Back to this. Good news. In November 2024, the average home price in San Francisco was only $1.3 million. Great. Good job. Wonderful. Really nice to see those numbers be so low. Clearly affordable by somebody earning $40,000 a year as a software engineer. No, Los Angeles, about $1 million. Oakland, about 750. San Jose, about 1.4. Interesting enough, we go to San Francisco, we look at these areas, they've gone across the board. We've seen increases across the board. Now, what do we know about what goes into the price of a house in California? And this is from UC Berkeley, the Turner Center, and real projects that actually they studied in LA. So unit in land, actually building the thing in the land that goes into it, basically 30% of that cost. Parking requirements, ensuring that parking is available, all of that zoning stuff, that's expensive to maintain. Fees and rules, carrying costs, soft costs, funding stack, all the stuff that goes into this. This is why why stuff gets stuff is ideated, but then doesn't actually result in production of something. Interesting. And so this thing too, especially if you look at, say, certainly the environmental laws, the litigation costs, all this other stuff, that all goes into these categories too, and that's difficult to maintain. Funding stack is just your ability to get those the funding lined up to build what you need to build. But imagine if you could cut some of this to get to a level where you could suddenly build for cheaper and how much more you could build. And I include this chart because you've seen this around Twitter at the bottom right. This is basically, we have this thing where we go right from detached single family homes all the way to like mid-rise and high-rise. There's a whole bunch of things in the middle, like townhomes and fourplex and duplexes and cottage courts and multiplexes and triple stacked homes. All that stuff you can produce equity in and you can build in higher density. And that could be in a lot of different places. Albert, you're absolutely right. And I keep saying this over and over. That's where it comes from. Thank you we had a deep dive into that some months ago now, but maybe we got to go back into CEQA, the California Environmental Quality Act, to kind of get back to a point where we can talk about the effects of that on development. But it's putting it back by years, and it sucks, and it has to change. Looking at San Francisco versus San Jose, a slew of shenanigans on board. Nothing big to report in the last year, though. Information as a whole still down 6% in San Francisco. The information sector in San Jose also down 6% in the number of jobs. That's a big deal. And indeed, it's the worst performing sector in both areas. The second worst performing sector in both areas is unfortunately also construction in San Jose, which is not brought out. It's not actually divided into construction in the San Francisco report, which is weird. But manufacturing is down 2.7% in the Bay Area as well. Fascinating stuff. So
when will it turn around?
Good question. Rates have to come down, right? We got to see rates come down. We got to see things happen. We got to see some of this stuff involving some of the economic issues. But I will say we are seeing still an expansion of VC capital in the Bay Area. That is the juice that gets the machine running in the information sector for startups. And so they'll grow, they'll be here. Even though you're only going to 3%, it is still such a big sloshing around with 1/3 of the entire dollars in the US, which is by far the biggest market. It's amazing, actually. So I'm optimistic for the future because you've got a lot of powder out there. as we say, to help build the next generation of competitive firms. But they won't deploy that until the conditions are right. Because you have almost half of all the VC, literally, you have twice the VC investment in the Bay Area as any other country. China, of course, being that other country.
Hmm. Wow.
Wow.
So
So,
optimistic, right? Good. How
so
much
as
of that is
we,
going to you guys? 129 billion. Let's split that between the 38 participants that are left in this chat room.
yeah.
2 billion for Melanie, 5 billion for Marsha, 10 billion for Aaron.
So
I
as we
wish.
get into the holiday season, knowing that we are a little over time here, and thank you so much for sharing with us your holiday joy this year, Dr. White. Uh,
Yes, surprise. Happy holidays.
the next time we meet will be January 28th, 8 days into the new Trump presidency. Between now and then, what should job seekers do besides maybe cry into their pillows? And how should they spend the holiday season as we look forward?
Ask Santa for a job.
Oh
Yeah.
my So as you get in this job for the holiday season, don't lose hope. I say this all the time. I feel like a broken record.
Yeah.
But on this, I think right now we are in a position. It'll be tough to, but whatever pans out next 6 months or a year, we're along for the ride. But there are opportunities in every economy.
Yeah.
Seize them, upskill, know all the things. Take that holiday break. Dig into, those old C++ books. No, those rock and roll.
Yeah, because I think
That's
about it, right,
terrible
where it's
advice.
like
That's terrible
you
advice.
to no fault of your own, you've given this piece of advice for the last what seems like half year to 8 months. And
Yes,
like
very repetitive.
like I guess the other question, and I see this question every month and I almost sort of gloss over them because it's repetitive. But the question is, when will things change?
Okay, good question. So we've got a new election at place. That was a big catalyst.
Yeah.
And change might be good or bad. It'll be a mixture of things. So I think you're going to see. So let's really think about this. It'll next year and year and a half. Positive side for businesses, they're going to be confronting an environment that'll be much more favorable to them
Mm,
from a regulatory standpoint. Bottom line, no matter everything this administration and the government says, it's focused on easing restrictions. And if they're successful in any way in that, that's positive. The downside is their trade policy is, yeah, it's off the charts challenging. And the difficulty is trying to figure out the magnitudes of those things.
yeah.
Oh, easing up on these things to help companies, that builds hiring, right? Also pushing that if the Fed continues to lower rates, freeing up capital, incentivizing a lot of this startup equipment. On the other side, you've got all those negative trade policy issues, immigration. If immigration gets locked up, all those are drags on the economy. And as a consequence, that creates drags. And it's all about magnitude and it's all about timing. And I don't know what's going to be worse than this. And that's going to be hard. If the It's going to be a free for all. I think it's going to benefit ultimately those startups. I think those startups will find capital, they'll find energy, they'll find resources. I'm optimistic in the next 2 years, we're going to see a meaningful turnaround in the information economy in the Bay Area, if only because of lower rates and a favorable regulatory structure. But this could go away like a poof of smoke if economic policies remain negative and remain so what's the right word? So protectionist. It keeps companies quickly regret or are unable to scale, for instance, or unable to do this because they lack capital, equipment, and resources.
So I think the other opposing meaningful question is, given that there will be a friendly business environment next year, might it be more beneficial for job seekers to maybe become entrepreneurs instead, depending on the industry?
Bam. If you want to make money, be an entrepreneur. Really. It's a risk though, right? And not
Sure.
everybody, not everybody can stomach it, but it is true. I mean, the most surefire thing,
Hmm.
really, at the end of the day that you can do if you're interested in your career pathway, at least be familiar with it. Go to a meeting of your local angel investors, your VCs, your other things. Maybe whether you got the capital or don't have the capital, learn about it, figure out how they think and how they work. Maybe you've got it in you and you haven't discovered it yet. And maybe you have within you an idea to make it work. And I think you should rock and roll it. I'm going to
We've
put my
got
LinkedIn info in the chat too for people. You're always Oh, host. I guess Albert would have to send it out. I got to send it out to everyone.
There we go.
Yeah, thank you.
We've got
Please link in with me if you got
Deadpan
any
Dash in the
questions.
comments here too. So
Yeah,
we've
yeah,
got a
yeah.
winner now.
That's right. So I think Albert, I think it is an opportune time if you're considering
Yeah.
a pathway towards entrepreneurship to do it.
Yeah.
It's risky. You could lose it all, but
Because
you could
Uber,
gain
Lyft, and
everything.
Airbnb were all
Yeah,
born in the Great Recession. So,
yeah.
it's really something there. So, all right,
What's the
cool.
story? 98% of all technology companies started in Albert's List originally. Is that what I heard? Is that right? That-
Yeah, we're right up there with Y Combinator.
Yeah.
All right. Well,
Albert and I started today's session talking about technical difficulties, and I said, why is there no product for helping me triage IT issues in real time? So anyone who's still here, that's a free idea, would make so much money.
three ideas on the webinar chat, and maybe we talk about entrepreneurship in the next one. So, for all those of you who are still watching now and later, thank you so much for your time. We do have our next one coming up January 28th at 5 p.m. We'll be recapping 2024, looking ahead, as we'll be 8 days into the new presidency and all the things that have happened since that has begun. In the meantime, please RSVP, ask your questions. No question goes untouched, although repeat questions may be ignored because we ask them so much. And until then, have a happy, safe, and wonderful holiday season. This is our final official webinar for the year, and we look forward to for having you rejoin us January 6th for how to build a side hustle with AI in one weekend. So entrepreneurship in that topic. We're coming back to you with that. So happy holidays, happy New Year, Merry Christmas, whichever, wherever you may be. Enjoy, and we will see you all soon.
Happy holidays, and may the jobs be with you.
May the jobs be with
God
you.
be with you.
Goodbye.